My name is Mike Castino. I'm with U.S. Bank, and we are a global fund service provider. We're a custodian and an administrator. For those folks over there, I'll just let you know, anytime, maybe I'll do this, it's a little better. I wanted to take advantage of the fact that anytime during the panel, raise your hand and any topic that comes up, and we can answer it right then. And of course, we'll have questions at the end too. And I want to thank Nick again for that keynote presentation. I especially like the part about being willing to take a loss. As a former futures trader, we never took losses. We just bought more and we averaged. So just ride it out. I've got a great panel here this morning, and new to market is exactly what it means. New to market, and it's going to be in a variety of forms here. So our panelists come to us in different shapes here and different experiences. Some, when we would say new to market, may not totally be a firm that's new to the market, but does deal with folks looking to get into this space as a new entrant. And then, of course, we have a couple other folks here who are new to market with unique strategies, and we'll unpack those a little bit and talk more about what their journey has been like to get here and where they are now, where they'd like to go. A couple quick things about that before we dig into the advisor role and the product-specific roles. What we're really talking about here are 40 Act ETFs today, so we'll focus on those that come to market under a trust structure, whether that's a shared trust where multiple advisors are sharing the same board and sharing the same officers and administrative functions, or whether or not that's a trust that somebody creates, maybe known as a prop trust, for example, where they bring their own board and they hire their own external counsel, external audit, external tax, CCO, those type of things. So once we get past that highest level of the necessity for a 40 Act trust and everything that goes with it, we hit the role of advisor, and we're going to focus on that. Under the 40 Act, it's spelled with an ER instead of an OR, just to delineate that role. And then, of course, underneath the sub-advisor, there would be what we would call the portfolio manager or the trading sub-advisor. Not necessarily those who bring a strategy, but those who help with the daily mechanics, creating PCFs, doing creation, redemption, and custom tax mitigation, items like that. So I really want to jump into it, getting past that, and really focus on the advisors and the folks that we have up here. So I'll let them go down the line in turn, introduce themselves, tell everyone about their organizations and where they are right now, and then we'll jump right into questions. So please, Jake.
Okay, do I need the microphone or can everybody hear me? Yes, okay. So my name is Jay Baker, and I am one of the founding partners at ETC, Exchange Traded Concepts. We are a white label ETF provider. We started the company in 2011, and as a matter of fact, myself and there were 3 partners, and myself and another partner actually launched the first ETF at Exchange Traded Concepts, and it was an MLP ETF. We launched a second one, and we ended up getting so busy with the platform, and we had a minor issue with another partner, that we sold those 2 ETFs, and we sold it to a major ETF provider that has about $60 billion so that we could focus on the platform. We've launched 78 ETFs, and right now we have 47 live ETFs that are on our particular platform. We've had a variety of customers. We launched a gold ETF for the Perth Mint. The Perth Mint is owned by the Australian government, and they were a client for several years. They had about $500 million in the fund, and they ended up wanting to sell the fund, and Goldman Sachs ended up buying it. We actually introduced them to Goldman Sachs and a couple of other firms. So we have had people that have used our platform as a launch pad and decided to leave us. And another example of this is we had a uranium product, and this product was launched about 2 years ago, and it started with maybe $5 or $6 million in it. It got to $1 billion. It started at $25 and got to 100 within a year and a half. The trading was maybe 20 or 25,000 shares. It exploded to 300,000 or 400,000 shares a day. Very, very volatile ETF, small cap uranium companies. And a lot of people, when they talk about liquidity, they'll say gosh, you know, we want super liquid stocks and everybody wants that. But the fact is, if you have a uranium index and the stocks are illiquid, on the upside, they move up to more viable. And that particular, and on the downside, they will go down much quicker. But the fact is that particular fund.
I'm sorry, the camera can't hear anything.
Okay, that particular fund got up to $100. And what happened is a company called Sprott came in and approached our client and decided that they wanted to buy that fund. So we recently completed the proxy, and that fund has left our trust and is now a Sprott product. So anyway, we've got about $6 billion under management. We had closer to $8 billion. Once again, when uranium leaves, you lose $1 billion in fees, and you lose a client. And we also have a portfolio management team that is managing about $4.2 billion. So that's sort of a quick overview of ETC, and I want to turn it on to the next guy.
Hi, everyone. My name is Tommy Mancuso. I am the president and founder of the BAD Investment Company. We just launched our first ETF in December, and that is the BAD ETF, which stands for Betting, Alcohol, and Drugs. I know, a little bit shocking in this world of ESG. I wanted to create a product that is unique, allow us to stand out compared to a lot of the big boys, I would say. So the portfolio itself is betting. That's going to be a lot of the companies you all see on the signs and stuff in Vegas. Alcohol, pretty standard companies there. And then drugs is pharmaceuticals and biotechs. We did carve out a little bit of a 10% allocation for cannabis just because of the growth in the industry. But at the end of the day, we think there's a lot of value and potential for growth with this allocation. You look at all the markets and everything that's going on right now, they all have steady cash flows, which is obviously extremely important, but they're also expanding right now. When you look at legalization of cannabis, legalization of gaming, drugs, when you look at that landscape and the outlook there, mRNA technology, it's going to be applied to other types of diseases and whatnot. So again, wanted to create this brand, I would say, to kind of protect some of these, I'd say, retail investors at the end of the day. There's obviously a void that needs to be filled, a lot of financial wellness. I've seen a lot of my friends ride the roller coaster up with AMC and all that type of stuff. But at the end of the day, we all know in this room that that's not going to last. And so creating a true play for something to for me to, I'd say, identify and relate to retail investors is important to me. Now, I do know that 100 shares at a time is not going to get me to where I need. So I think there's also a lot of value, and there's a space for this contrarian ESG spot, because I don't think anyone in this room right now can necessarily tell me what is an ESG fund. There may be 150 of those right now out there, and I'm sure every single one is different. And Tesla just got kicked out of the S&P 500 ESG index. Interesting. So again, just kind of wanted to be a little bit of an alternative investment manager, and we're going to have a series of funds. I wouldn't say I'm not open to an ESG fund by any means. I don't want to get too hooked on that, but again, I just like to look at where are we today, where are we going tomorrow, and we're going to adapt to those times. But at the end of the day, people are going to get sick, people are going to drink, and people are going to gamble. So again, it may just be a little bit recession resistant, and that's what we're kind of looking for. So thank you.
I'm Bill Cannon. I'm a portfolio manager at Valkyrie Investments. We are a crypto-focused digital asset management firm. We have 3 products right now. The first one was the BTF, which is our futures or Bitcoin futures fund. That came after a larger competitor, and we think that it's doing really well in terms of gaining access for investors looking for exposure in a portfolio with specifically Bitcoin. Our next one is VBB. It's more of a Bitcoin-focused fund where we try to the original idea was, which was done last year, was looking at companies that actually hold Bitcoin on their balance sheet. Back then it was 2. And again, you can look at, that's the power of the blockchain. You can look at, it's pretty transparent. You can look at, there's numerous websites where you can see where Bitcoin is held on the balance sheet. We're also looking at focusing on companies, specifically in financial sector, that also transact in Bitcoin and other cryptocurrencies. that is kind of a smaller fund, and we see there's going to be I think like a more forward-thinking thought on that. Everyone has thoughts on crypto. I should probably introduce that. And it's when I speak to investment advisors, it's a challenge to see where people think of crypto. Everyone, I mean, let's just be honest here, more of the older folks, they don't see a use of it. They don't want to learn about it. But I think unbeknownst to them, it's this technology of the blockchain, and which is Bitcoin in terms of an entryway, is going to infiltrate into our lives. Like you said, like there's certain ways of looking at stuff in terms of how certain sectors affect your life. The financial form, and also there's going to be a lot of society, how can I say, aspects how blockchain will affect your lives. I just think that it's probably early, and it's certainly this time of the market, it's kind of unfathomable and see how it can come up, but it will. I mean, it's just a matter of a little bit of time. Last is our miners ETF. That is, again, a lot of folks don't know, it's Bitcoin miners. They are a proof of work strategy, or I should say protocol. Again, this is a somewhat forward-thinking fund. I would say in 5 years, and this is maybe definitely a forward. Bitcoin miners will definitely be part, or not definitely, but I think will be part of the electricity grid as they help not only electrical companies mitigate their flow of electricity, and not only from a production side, but also from a consumption side. Valkyrie itself is mostly, I would say, half and half. We have a common how could I say, friend that is more of a traditional finance side. We probably a handful of traditional finance side coming. I myself come from a fixed income and derivative side. And then we also have the younger crypto native guys. We have set up a ton of funds that, not a ton, but I would say a good number of funds that have really allowed investors to get either a specific view on a certain coin, or as well as a multiple coin product. We also have a decentralized finance hedge fund that's also a little more advanced in terms of what you're seeking in terms of performance. But again, a lot of these products are, they're young, and it's just taking investors to kind of learn about it and see what's going forward. So I'll leave it there.
Great, thank you. And you can see quite a bit of different product across the spectrum, and we didn't want to bring something that was plain to you today. We wanted to bring some unique strategies and also unique decisions as to why certain avenues were chosen to bring these products to market. So with that said, we'll start back on the end, Del, and go to Tommy, and then back to Jay, because Jay can have a foot on both sides. For example, the decision point: can I be the advisor? Should I be the advisor to an ETF? Maybe you can go through some of the things you considered as a firm as to why or why not that was right for you. As you know, there's the ability to become your own advisor, starting your own trust. There's the ability to be your own advisor in a shared trust. And then there, of course, is the ability to rely on another advisor in a white label scenario. So we'll start on the end and move back towards Jay.
Yeah, that's a great question. I think in terms of crypto, it's probably benefits to have some kind of diversity in terms of not a specific one coin or any kind of protocol or any kind of company that is probably their main focus, their main corporate focus is on cryptocurrency. Should you start it? I think the opportunity is there, especially right now, especially at these levels. I always say that crypto is, there was probably some other basket of investments that you could think of, but crypto is definitely the first one out in times of uncertainty. It's definitely relevant right now. However, like crypto experienced, and a lot of guys probably heard about the stablecoin fiasco, kind of a run on the bank, if you will. I'm always trying to find like corollaries between the traditional finance world and the DeFi world. It was kind of experienced last week. And then this week, we have the Target news and the retailers. And then I looked at Bitcoin, and it didn't really, it's finding traction in terms of a correlation to traditional finance metrics, or as we just call, just regular, the S&P. I always use the S&P. But long story short, I think that what we need to happen in cryptocurrencies is more of a divergence, more of what the dollar is doing right now. In terms of the dollar strengthening, we see Bitcoin as an entryway again to financials. I mean, to financial technology. It doesn't really relate to the market, which is why it was built. Again, investors need to kind of to keep track of this. It's hard. It probably takes a couple days, but in terms of building products and finding more opportunities, I think ETFs are a great opportunity to have. We'll probably speak on a couple challenges later on, but I'll just leave it there.
Yeah, for us, we launched BAD under the U.S. Bank Series Trust and primarily outsourced everything. And that's because it's all about gaining assets in your first couple months when it comes to launching a product. So that's strictly where my focus is, because me kind of playing with the back office doesn't do me any good to try and collect assets. So kind of outsourcing all of that is really advantageous for me to be out there on the road, having conversations, trying to sell our product. At the end of the day, right, we do use a sub-advisor even for the trading at the trading side, at the trading level. So again, as I kind of mentioned, right now we're a marketing firm to some extent, just trying to promote BAD. But with that being said, pretty straightforward with that. And, it's tough right now to get a lot of, I'd say, smaller RIAs or anyone to kind of take on the product. But when you look at the track record, you look at a kind of a low volume and all that stuff, we're going to get there. It's just a matter of what's going to be the fastest way. And using a trust, I think we're always going to go that route, just because of the opportunity it allows me to get assets again. So fairly straightforward here, but.
Yeah, not so straightforward here. You can imagine we've got 47 products out there, and we've got 20 masters. We've got 20 different clients, and they all think differently, and they all want to market differently. So what I would say to start off with is, in the perfect world, we've had a couple of clients that have started with $1 billion. And when somebody comes in with $1 billion and wants to launch 4 products, which we did for a product called Cabana, they are now up to, well, they were up to 2.4 billion, but they're at 2 billion now. Wonderful, because they're immediately profitable. There's trading going on. And now they're going to do another 8 products. So this is great for a white label platform, but not everybody has $1 billion to bring to a product. Another firm, Six Meridian, I think they came in with about 300 million. They were an RIA, they wanted to launch ETFs, so they're up to about 600 million. Once again, profitable, great client to have, but this is very, very unusual. Most people don't have that type of money to put into an ETF. And what I'd also say is very, very hard to start with 2 million or 3 million and launch an ETF. It's difficult, because I've been doing this for 11 years. So a couple of comments on that. One other comment on, I'm one of the older guys when it comes to crypto, so I'm not going to go into this, but we had 2 clients that we have that wanted to do crypto, and we're absolutely willing to do it. We're still working on a spot. The other one was based on futures, and they've pulled back. But I will bring up another thing, being in a platform, being a portfolio manager, with the crypto ETFs, with the futures, in order to create that particular structure, you need a Cayman sub. And the Cayman sub can only hold 25% in futures. If you only held 25% futures, you're not going to get one-to-one performance with Bitcoin. You need to hold more futures than that. So what we had to do, what we were on the road to do with this client, we were suddenly going to have to do a reverse repo. Because with the 40 Act security, if you have 100 million, you can borrow another third, 50 million. We needed to get up to another 50 million. The fund started off. So what does that mean for us? Out of the blue, being a portfolio manager, doing index products, doing foreign U.S. equities, now we're in the reverse repo business. And we're calling up bond dealers. And we're signing documents. And we've got the lawyers and the compliance. So I'm saying from our standpoint, this became actually somewhat complicated. I know that people do it. I know ProShares has a reverse repo. But this suddenly, as a white label, suddenly we're sort of doing more than we expected to do. And we found out about this later. So we priced it at this level when, quite frankly, we should have priced it much higher based on that. So these are sort of things that come up recently, because there are a lot more complicated products using futures and options, and what it means for us with being the portfolio manager. It's more complex. We can do it. It's more legal. It's more compliance. It's more due diligence. So that's something that right now we're holding off on. We've got a much better feel. If somebody comes in and said they want to do a foreign currency futures ETF, whoa, hold on. Let's talk about this. Let's talk about the cost, because we're going to have to charge a lot more for something like that. And look, we have a lot of smaller clients that come to us. And in some respects, it's like an options business. View a white label. You have a portfolio of options. You want the options to go deep in the money. You buy a call option for a certain price, the stock doesn't move, you lose that money. You buy a call option on Tesla at 700, it goes to 1,000, that option's deep in the money. It's worth $300. So we've got all these call options. We hope that the fund goes deep in the money. We hope it starts at $2 million, we hope it goes up to $500 million. Then it's deep in the money. We get basis points and we get minimums. We make the money on the basis points. The minimums sort of just make sure the doors stay open. So we're always hoping that when we take on clients that their product goes deep in the money. And last comment I'll make about clients in general, when I think about all our clients and the ones that have been successful and the ones that aren't as successful, I think about 2 or 3 of the clients, and this is just my personal opinion. We've got a couple of clients that I'll use EMQQ, which is basically the Amazons of emerging markets. This individual at launches, he did nothing the first year. And if he was in this room sitting there, I'd say, you did nothing. He would say, I did nothing. He started getting out and speaking to people. And a glorious example of this would be Catherine Wood. He's not Catherine Wood, but he's out there speaking. And one of the things that he started doing was, I call them micro webinars. Now, he's done Tom Lydon's, he's used Tom Lydon, but what he's doing now is he's in Raymond James. And to give you an example, what he'll do at Raymond James is he will send out an invitation to Raymond James financial consultants in Florida, not the whole country, not 10,000 emails, just in Florida. And he'll say, this is a 30-minute webinar in EMQQ. If he says it's an hour, they've tested out all the different invitations. An hour, you get a drop-off. 30 minutes, more people say, hey, we'll listen to us. He can't talk for 30 minutes. The most he can, he's never been able to talk for 30 minutes, but 30 minutes brings in more people. If he uses the word exclusive, more people tend to come to this thing. So people might say, and a lot of times he only gets 15 or 20 people at these seminars, and you probably think, that's terrible. I think Tom Lydon gets 600. The thing is, there's no continuing ed. Those 30 people, the only reason they're tuning in is because they're interested in the product. Second of all, if there's a Raymond James financial consultant, this individual will talk to that individual for an hour because he's a Raymond James financial, or she is a Raymond James financial consultant. They have the ability to buy ETFs. If he can do a Zoom and speak to 15 of them, 20, 30 of them for an hour for $500, that's a bargain, because he knows the 15 to 30 have the ability to buy. So he's doing these things 2 or 3 times a week all over the country. Morgan Stanley, LPL, any particular group that he's in, he's been doing this. Robo does the same thing. And what I found with them is they seem to be able to gather assets doing this.
Yeah, thank you on that. Any questions right now for any of the topics that we covered? Yes.
Bill, if you could comment, yeah, Mike Kosak from ImpactWise. If you could comment on just the distributed ledger, blockchain, and just the security of that, and some of the hacking stories that we've heard.
So just like a brief introduction of the blockchain and how it affects us, and then the hacking, or is that?
Yeah.
Okay.
Is it secure?
Yeah, is it secure? That is the reason why people, just to answer that, that's the reason why people have chosen Bitcoin as it's the most popular, it's in the most headlines, but it's because of the proof of work methodology, it's very hard to hack. You are not going to convince, 51% of the nodes, or let's just the nodes, or how I should say, it's people that are involved in the Bitcoin protocol. You're not going to convince them if there's a potential hack to go for. mostly whenever you hear about hacks or whenever you hear about security breaches, it's probably how can I say, user involved, meaning that, let's just say there was a Bitcoin, how can I say, robbery, if you will. I think they just discovered some robbers recently in New York, ordering like a pizza or something like that, and and they used a digital payment, and that's the reason they got that. Just saying that right there, as a digital payment, Bitcoin, everything is on the ledger, everything is posted, everything is transparent. I'm still learning about certain applications that you could simply put in an address, and it could tell you how that address interacted in terms of the past, in terms of the history, and as well as where do they put that wallet, where do they distribute their funds or their coins, or looking ahead. And you keep on looking at, it's kind of like a little puzzle, maybe not as transparent for the normal person, but you can see it. That is what is appealing about blockchain. That's what's appealing about this whole technology. How does it go? I wrote a little piece. I hope you guys take like 5 minutes. I'm just going to tell myself here. But it's like in terms of like blockchain, I was trying to find optimism in this kind of like down market here for crypto. Blockchain, there is just so many more uses besides financial, besides these NFTs and stable coins, right? It looks more of insurance, right? Certain people can now put their identities on a blockchain, on a more secure blockchain, and that will be them. Voting would be a great solution in terms of blockchain, having that individual identification and having that, and that is the kind of appeal that I'm trying to tell people, that positivity about the technology of blockchain. Crypto is for lack of a better word, is a bet on financials. Mining is a bet on electricity. And it just takes a little more time in terms of these sectors to develop, in terms of more people to engage with it.
Thank you for that. Any other quick questions before we move on? Sure.
Hey, this one's for Bill as well. My name is Paul Spiropoulos from Citi. With different blockchains moving from proof of work to proof of stake, how do you think that's going to affect the mining industry, and further to that, your mining ETF?
Just to let you know, like proof of work is more, that's what everyone has, this negative connotations in terms of environmental. It just uses up a ton of electricity. North American miners are now located mainly in like West Texas, but mainly the more central. There's even an area for renewable energy up in the Niagara area. But in terms of proof of work, I don't think it's, in terms of proof of stake, I can't really comment, because it still needs to be, I think we'll probably find out in another couple months. But in terms of proof of work, these miners are investing tremendous amount of money into their infrastructure, including what miners are, everyone, if in case you don't know, is basically is as simple as a CPU unit. They're specific computers made to mine. And there's 4 or 5 giants in the mining industry. Those guys are investing heavily. They're also, you could see a lot of their infrastructure that they're building across the country is amazing. I would say, and we've always said this since the end of last year, you'll now start seeing like a fruition in terms of their investments. Now towards the end of the second quarter, but definitely the third and fourth quarter. The hash rate, which is the metric of performance and efficiency, is already at an all-time high, and we will see that continue to grow. So I think that there's tremendous value just in this year. The miners are excited already about next year.
Okay, so thank you for that. Let's jump back into moving back to the advisory and the sub-advisory side of it, and then we're going to finish with a discussion about assets within the, let's say, independent channel, the intermediaries, because we touched on 2 different silos here. We touched on the captive side of it, as Jay mentioned, with folks who are bringing assets to the table prior to launch. And then we do want to have a conversation about what our panelists are doing up here and their clients to go out and capture it from the broader market. But just want to touch on one key thing here too. At ETC, they also run a sub-advisory business, and as Tommy mentioned, he hired a sub-advisor. So just want to put some clarity around what that means, because traditionally in the mutual fund world, if you hire a sub-advisor, people are thinking about, hey, that's the person running my strategy. But it's a little bit different here, right? Think in terms of the trading sub-advisor. Someone who's going to help you on a daily basis with the portfolio composition files, getting those right. There's 7 different basket types out there available to be used now. Do you know how to use them? Do you have a dance partner, for lack of a better word, who will help you use them out in the capital markets world. So things that are really, really important like that, I thought maybe, Jay, you might be able to shed a little bit of light on that.
Sure. So we were outsourcing the portfolio management for ETC for years, and 4 years ago we decided that.
Sorry to bug you, Jay.
So about 4 years ago, we decided that we should have a portfolio management team. So this is a heavy lift, the Bloombergs, the talent, hundreds of thousands of dollars to do this. But we thought we wanted more control, and we decided to get into that business. So we do have 4 people, and we hired an individual that's really, I would say 3 of them are coders, quants, engineers. We've got one hardcore ETF trader, but the rest of them write code. They're engineers. They're one of them in particular. His mathematical abilities are literally incredible as far as creating this portfolio management team. Even the 6C11, you have to have a bid-ask analysis done every single day, and there are lots of firms that outsource this. Bloomberg does it, a few others. He did it on his own. He said, I can write this by myself. So we got into this for several reasons. One of it was a bear hug with the clients. It tightens the relationship up with the clients when you're doing the trading. Another very important thing about being a portfolio manager, and we were up to about $6 billion, we've got $4 billion, we're sort of controlling the rebalance business. Now, we control it with our client, but the fact of the matter is when you have $4 to $6 billion of rebalance, the lead market makers, the bulge bracket firms like Citibank and Goldman are all interested in this flow. I mean, it's really the crown jewel of order flow, right? It's program trading. So a form of program trading. So all the firms are interested in this. Now, we do trading with Goldman Sachs. We do trading with JP Morgan. But the fact of the matter is when you have a white label, you need a lead market maker. And you need somebody to seed the product. The seeding of the product is much easier. You used to need 100,000 shares, and if the product came out of 20, that would be $2 million that the lead would put in. Now you can have 5,000 shares to start with. Why has it gone down? Because the lead market makers have balked about doing 100,000 shares. Why? Because you don't know what products are going to do well and what aren't going to do well. So if you seed a product at 100,000 shares and it's at 25, $2.5 million sitting, the product's not doing anything. If it's 10,000 at 25, it's 250,000. Not as painful to have that on your balance sheet. But another reason, one of the reasons we did the portfolio management is we control the rebalance business. So when you have these funds that are rebalancing, whether it's Cabana, whether it's Sixth Meridian, any of the larger funds, we have to dole that out. We have to give that to somebody. So who do you give it to? Well, some of the firms that we give that order flow to, and we don't give it all to anybody, is Virtu, is Jane Street, is GTS. Why? Because they're lead market makers. There's no wink and a nod, there's no handshake, but the fact of the matter is this is the flow that they covet more than anything. If they're getting that flow, they're more willing to be a lead market maker. So that was, and this has helped us tremendously because the fact of the matter is, and I was in that business, I was at Goldman Sachs, and we were lead market maker in 450 ETFs. Those days are over. Those were all given back years ago. I mean, Goldman got out of that particular business. It was a very, very lucrative business 15 years ago, but as time went on, not as lucrative. So most firms don't like being a lead market maker. They would prefer not to do it. They're doing it to try to get other business, and some of that other business would be rebalance business. So we also offer out the portfolio management service to really anybody. And so to give you an example, if you're familiar with Round Hill, we're the portfolio manager for all their products. They're their own advisor. They're involved with you guys, I believe, right? So they're going through your board, right? Yep. So they're going through the U.S. Bank board. They're their own advisor, but they outsource the portfolio management to us. They just started launching products in Europe. We are the portfolio manager in Europe. Once again, Round Hill has raised about $1 billion. Actually, they're a little bit less now, about 750. They decided to launch in Europe. This is a cost to us, legal,
Legal compliance, lots and lots of hours to get set up to trade over in Europe. But the fact is, with a client like Roundtable, it's worthwhile to do based on their track record in the U.S. So that's why we got into that business. And that business, in the end, that business will have more assets in it than I think ETC will have as a whole. And we're doing most of the ETC products, but there's a little bit of a moat being a portfolio manager. So for example, Goldman Sachs has a bunch of ETFs. They're the portfolio manager for their own ETFs. They don't outsource that service. Neither does Credit Suisse, neither will Morgan Stanley. So there are only a handful of portfolio managers out there. It's sort of, we're filling a void because you don't have a lot. There are many, many firms that you know, there are a bunch of custodians, there are a bunch of tax firms out there, but when it comes to individual portfolio management firms that will take new clients, there aren't a lot. I mean, there's, like I said, there's somewhat of it's an oligopoly, and that's another reason that we got into it as well.
Yeah. Thank you, Jay. Any questions on that role about that trading sub-advisor? Again, overseen by the advisor who sits in that seat, working on behalf of the portfolio in conjunction with the capital markets folks. So obviously, Jay can unpack that further for you if you have any questions on that. But I wanted to pivot back to that all-important category of AUM gathering. And again, we kind of framed it out as captive AUM. AUM, as mentioned, you know, folks coming with $1 billion or coming with $300 million. That's a pretty easy yes to any of us sitting up here as service providers. Love to help you do that. Yes, we can get you in business pretty quickly. Those who have to go out and capture AUM from the broad market. You know, you may have heard somebody say, my plan is just to get 0.5% of the AUM from the S&P and then I'll be happy, you know, versus the SPY. Well, that's great, but what's your plan? So everything here, when you capture AUM, everybody in this ecosphere, from service providers to lead market makers to the exchanges, everyone's going to want to know, what's your strategy? What are you going after? Because obviously, I'd say on average, you have probably about a two-year burn rate before you probably turn the lights out and shutter the fund, which is, again, it's nothing embarrassing in our industry. There's folks who do that even at the largest firms. But what's it take? What are you doing right now? Independents, intermediaries, we all hear about due diligence thresholds. We all hear about gatekeepers, how you get their ear, how you have an audience with them. How do you find out what their expectations of you are other than just being listed? That doesn't cut it. Retail investors who have their own self-directed account can probably trade your ETF, but beyond that, when you step into anything that involves a fiduciary, there's requirements. So wanted to spend some time here, and we'll come back, Jay, to the captive side a little bit more, but going out and capturing it, what's been your experience? We'll start with Tommy.
Yeah, so obviously, you know, getting assets, as you mentioned, is the key to the game. And, you know, when I kind of had this vision for BAD, right, it was tailored to the retail investor because everyone, when the pandemic happened, thought they were the greatest stockbroker, their own greatest stockbroker in the world. So how do you get in front of those people and sell them your product, right? Because ETFs aren't necessarily so sexy as an individual stock or position. So getting in front of them, a lot of digital marketing. The challenge there, though, is when we run an ad campaign or something on Instagram, we can't tell if that person went and bought anything. We can't see that. So again, I think it's that whole drip and messaging that is getting in front of them, being consistent, having a performance and a track record. Now, again, the big challenge with retail is, you know, 100 shares at a time is not going to get us where we need to be. So what's going to get us to that RIA space? And a lot of that is just being candid with the RIAs and saying, hey, we are a new fund. We have an index that you could look at our track record for. And if you're willing to take a little bit of a risk on us and just kind of look at the facts behind the scene, we may have an opportunity to provide you a little bit of a risk-adjusted return with the BAD ETF to your clients. Now, what I've gotten is I'm going to buy it for myself from these RIA and portfolio managers, and that's how they kind of will, you know, maybe throw $10,000, $20,000 at it themselves, see how it performs, and then our whole goal is just to always consistently be following up with them. And that's essentially all we can do at this point. You know, the way people get their information is different right now, and we just got to adapt to those times, I would say. And you know, a lot of that is in the digital space, but it's also being in front of them and having just a truthful conversation. I think people appreciate that at the end of the day. And you know, sure, there's going to be challenges with no track record at this point in time. You know, it requires a little bit of risk, but that's a part of it. And you know, just kind of being in the grind is what I enjoy doing at the end of the day. So whatever it takes, I suppose.
I definitely agree. In terms of crypto and how what we do is we're trying to, just like you said, we're using a lot of social media, Twitter, we're using our own sites, our own distribution group and marketing group. We're trying to get out there almost daily with information that investors can use, investment advisors can present to their clients. We present, 2 or 3 not podcasts, but again, I don't know how to call them, an advisor series on education on what this could do. I am certainly focused on talking to investment advisors, educating them on what crypto is beyond Bitcoin. I think some of the stigma of here being Americans is that we see Bitcoin as a performance play. It's kind of frustrating to think about that, but if you actually look at some of the other countries, I know some folks may laugh at El Salvador, but it's just, we have to understand that those guys were seeking a solution for their currency that didn't work. My parents are from Peru. I went there at 8 years old at 84, and there was this new currency. It was called the Inti, and it was 20 Intis for $1. I came there two years later, and it was 5,000 Intis $1. Inflation is it's an incredible problem outside of the borders, and I think what we as Americans see as crypto as a performance play, it's there for a reason. I wish that something else could be more kind of from a conversation point beyond Bitcoin. You'll get a lot of guys, crypto experts, saying what they want to say about Bitcoin, but it's an entryway for the normal investor. It's an entryway for people to understand the security issue. Bitcoin is secure. It's transparent. But there are obviously some more, there's a lot more and yet to be discovered. Uses for the blockchain, uses for the technology, uses for, we understand even our head of venture is looking into a blockchain for use for the medical records. Google tried it. I don't know what the status was, but I remember signing up for it like 10 years ago. But this group out of Israel is trying to see if they could get blockchain to integrate with the medical records, more efficient for doctors, to get it more efficient for insurance. Again, I could go on. Insurance company, they're also doing their own thing with the blockchain. But it's just a matter of, like you said, getting on the road, getting out to people, talking to investment advisors, getting them educated. The journal and more headline, more, I should say, historical newsprint guys, those guys, the Journal and the Times, those guys are also doing their more features on crypto, especially like the last 3 or 4 weeks. I think that's important for people to adopt.
And just to add on, I think, you know, one thing we did, and we always see an uptick, is we hired a PR firm, and they've helped us get into a lot of, I'd say, publications and whatnot. And, you know, it's an easy kind of sell or pitch, but we always see an uptick in volume a couple days whenever there's an article posted. So having that PR is extremely important, I think, in the process. And then you can recycle that information. You go to a website or something that says Bloomberg, you know, at Wall Street Journal, all of those. So it kind of gives you some credibility at the end of the day as well.
Yeah, thank you. And any questions on that, really quick, on that capturing assets side of the business?
You know,
Sure.
I can't control myself. I have one question. It's not I got you
Jay,
question.
sorry. Jay.
You have,
Sorry.
Sorry about that. So, you know, you see this Coinbase that's been extraordinarily successful, right? That went public and I think touched 400, went down to 50, you know, some major problems there. Then the CEO comes out and basically says that, listen, we're not going bankrupt, but if we did go bankrupt, that $200 billion in Bitcoin is probably, you're not going to be able to get it to the clients. Which means, I guess, if you buy Bitcoin through Coinbase, you're transferring something to them where it's you've lost a little bit of control of your wallet. Is that the right word? So when I hear something like this, I'm just thinking about myself. If I had money in Coinbase, I would have amosed hearing something like that. And I know he says he's not going bankrupt, and people said Bear Stearns would never go bankrupt. So what does that freeze the? Do you think that freezes crypto, or what do you think the fallout on that?
There's two aspects. Yeah, that's a great question. There's two aspects. First of all, Coinbase is, I think most of the people here, if they wanted to, if you got asked, how do I access crypto? How do I get in there? How do I get a wallet? And I'd say one of the first answers is Coinbase, right? Even my old boss, he wanted to get access to an offshore gambling site. How did he do it? And I couldn't believe it. He's like, Bill, I opened up a Coinbase account the other day. I couldn't believe it. But that said, I think that the alternative for those users for Coinbase, they could open up in order for them to get a wallet to hold actual Bitcoin, to hold actual cryptocurrency, they would have to go to a competitor. And it's the same process, right? If that competitor was going through the same challenges like that they were going through, the accessibility is limited, let's say. That's where the ETF comes in. That's where the Bitcoin future comes in, where we're allowed exposure into the cash. We're allowed exposure, regulated investment vehicles, everything like that. That's the reason, that's the appeal for the ETF.
You've got a futures contract guarantee.
Right, and hopefully the spot, hopefully the spot, which is obviously more efficient, hopefully it'll come through. I always like to say that the United States, along with a small country in Africa, are the only two countries that don't have a spot exposure. So that's a challenge.
We had a quick question in the back.
Yeah, hey, Mike and Jay, you guys might be able to kind of navigate this question. As for new issuers, right, I think there's folks in this room, and you got a whole bunch of market makers and LMMs sitting back in this corner. Can you help potential or prospective new issuers think about, as you're looking at AUM growth, an ETF is a lot different than trading Apple stock, right? So whether it's a retail investor or an RIA you're getting into, how are you ensuring that your clients are getting best execution getting into a product, and that performance doesn't skew kind of what you guys are doing as portfolio managers?
Yeah. So we have a good relationship with all the market makers. We've known a lot of them from the American Stock Exchange for years and years. We have a portfolio management team, and the head of the portfolio management team at Goldman Sachs used to make markets, electronic markets, in 700 ETFs with 3 or 4 people. So we're on top. We're on top of the bid-ask spread and the liquidity in all of our products. And we're friendly enough with, if we do see a spread that we think is outsized, we do contact the lead market maker and get a discussion. They always have an answer, and it's a credible answer. But we watch that. We monitor it. All the rebalances we monitor it right down to the last cent, to the last second. We have the ability to do that. It's not me, it's the individuals we've hired that used to do, we're on that side of the business and also on the program trading side. So we feel we've got a very, very good handle on that.
Yeah, I think I'll throw one other quick thing in there. Some of the conversations we have with new issuers, and I know this isn't unique to my conversations as a custodian administrator, it's across the board. So you don't want to put a square peg in a round hole. You're creating this product for use not only for your investors, but also for the vital folks who make a bid ask every single day. So if there's something in there that's not right for them, then naturally they're going to have a problem putting the bid ask spread in a place where they can best do that. So consulting with them, let's say when you're optimizing your portfolio, or taking your first draft of your prospectus to them so they can see what you're trying to accomplish, and then optimizing it through their lens, not just yours, is an exercise that's well worth your time, even if you think you've just created the best portfolio possible for the use for any market maker out there on the street. Don't take your word for it, take theirs. So before you do that.
I'll make a couple more comments. And one of them is there's no such thing as wide spreads, only narrow minds. That wasn't my original thinking, but somebody said it 10 years ago. What I'll say is we have several products that deserve a wide spread, and uranium's one of them. And when you have an index of very, very illiquid uranium mining companies, they are difficult to trade. And if you want that ETF out there and you want to be able to purchase it, it's going to be a wider spread. If you're trying to day trade it, that might be a little bit difficult with the wider spread. If you're holding it for the long term, that particular product started at 25 and it went to 100. So, for a long-term investor in that, the wider spread, totally justified. And there are certain products where there are certain products out there that are more difficult to trade, and they might be more costly to trade, and that translates into a wider spread. So it's totally justified. It's when we have these discussions with the market makers, they're on top of this. We're sort of on top of it. But every product is a little bit different, and there are products that should and do have wider spreads.
Any other quick questions? Yes.
Yep.
So you said you're wanting to get to the retail investor? Oh, sorry. You said that you want to get to the retail investor and market to them, but are you afraid that retail investor getting into the market is like drying up, or?
I would say no at the end of the day. I think since the pandemic's happened, people are way more interested in the markets, and they may have been beat up a little bit now, especially in some of the stocks that are down. Take Peloton, 90% or plus. I think this actually provides an opportunity for the bad investment company to attract these retail investors, because we're going to offer them some broader level of diversification, provide them a product that is going to treat them better in the long run. Now, are people going to have a little PTSD of considering what's maybe happened over the past several months and be maybe a little bit hesitant? Sure, but I think the retail investor, let's just say anyone under age 35, maybe they were just investing because of their stimulus checks, but these people also are getting more business acumen. They're going to grow. So if we can grow with them, they're going to have a lot of money to invest, and they'll be comfortable coming back into that market. So as long as we stay relevant in front of them, I think the retail investor is here to stay. And I think you're actually going to start seeing, I think, brokers disappear a little bit more. I do work as a financial advisor that pays the bills right now. Hopefully not for long. We can shift. But I think in this new era of investors, you have information at your fingertips. The barrier to entry is so much lower than what it's been in the past, that I believe that more people are going to look at themselves, look at information, what people are putting out, good information in front of them, and the retail is here to stay. So,
I just had a question really for obviously any of the panelists, but you talk about the chicken and the egg situation that you have when you're trying to get your product onto any type of platform where you don't have enough volume, and there's certain barriers that you just hit, especially in the beginning. And to be able to get that volume, it would be great to be on those platforms so that volume could come, and you're obviously going to be able to get past those gatekeepers. Could you just talk a little bit about the investor education that you guys have to do for that specific time period, where, especially when you're not seeing the volume on the secondary market, maybe a lot of people feel like that fund isn't liquid enough and they won't be able to do the creation and redemptions to keep the spreads as tight as possible, and just around the education for that specifically, because I feel like that's something that a lot of investors that aren't truly educated around the ETF product structure in the way that it has that dual level of liquidity don't necessarily understand, and that's why there's a lot of those types of barriers to entry that come into play.
yeah, I can take this. That is something I've actually been working on at the end of the day, because sometimes you'll see that we have less than 1,000 shares traded sometimes, and people are like, well, it's not very, that's not very liquid or anything, but you can always get a price, or you can redeem that at there. We've worked with GTS, and they've been great at keeping our spread within a 10-cent range, and I think we've been averaging around 6. So with that being said, I'm trying to create some educational pieces, I've been working on this for about 2 weeks, to kind of get that in front of some people to say, it's an ETF. Every position in our holding or in our deal is extremely liquid. So if you want to redeem that, you just put in your sell order, and you may have to get it at that base price, but it will trigger, right? It will be executed. There is a challenge right now because there's a lot of financial wellness that I believe needs to be done to the retail investor still. And they are just maybe taking what they've heard or hearsay type of stuff where they don't fully understand that. So that's a big part of our value proposition while we grow this company is providing a trusted resource that can relate to the retail investor. And that will obviously be one of those topics we attack head on. So.
So it's difficult in the beginning if you have super low volume. We try to get clients, and once again, this is difficult, that have $10 or $15 million. And if you have $10 or $15 million, what we tell them is, unlike a mutual fund, don't plop that $15 million in day one. Feed it in its volume, carve it up. And if you have 6,000 or 7,000 shares a day, and you've got a new ETF, that's actually a good comfort level. 1,000's a little bit low, but people still look. But 6,000 or 7,000 shares, if people see that for a couple of weeks, because they're going to hit up the symbol. Nobody cares what the assets are in the beginning, or 90% don't. They hit up the symbol, they see if there's volume there, and the assets come later. So if you can get 5,000 or 6,000 shares traded a day for a couple of months, that's extraordinarily helpful. And look, I mean, the other thing we do, and everybody's going to do this, and including these guys, but we have a distribution roadmap. So we've sort of got a file on Morgan Stanley, AG Edwards, all the broker-dealers that are involved with ETFs, and every interaction we've had with them, good and bad, is in this file. So, I mean, what we tell our clients, I mean, the first stop generally is LPL, and LPL at this point, if you're an index ETF, if you have $25 million and you've been out 1 year, and by the way, in the old days, it was just $25 million, immediately you were approved. You have to pay a fee for it, one-time fee, not a yearly fee. But that's what we try to get our clients to get to 25 million. So you can get to 25 million and you're an index ETF, you will be most likely approved at LPL. And I think they've got 14,000 independent brokers. EMQQ does webinars at LPL all the time. BlackRock's involved with LPL. So then, if you get up to 40,000, I'll use Raymond James at 40,000. If you're an index, they've pulled back a little bit on the active. They'll start approving active again. But if you're an index and you get to 40,000, if you get to 40 million rather, you're automatically approved there. So once again, they have 10,000 financial consultants. Once again, EMQQ is doing those webinars with Raymond James all the time. Florida, Tri-State, California. And the good thing about that is you're hitting Raymond James 12 times a year instead of sending out a massive 10,000 emails to all of them. They wouldn't like that if you're doing that week after week. You'd hear that. So you pick an area, pick an area, pick an area. If you do a good job and you know how to tell a story, the word gets out. Other brokers in different areas of the country will probably tune in just because of that.
So we do have a little bit more time here, time for more questions. I just wanted to, little recap. So some of the things I guess I learned from the panel today, skip the 1940 Act boring stuff. Nobody wants to hear that next time. I have a Bitcoin account, but it's with Coinbase. So while I feel younger, I feel in jeopardy, but I probably can, but I can gamble with it and buy alcohol and drugs with my Bitcoin, so I
Hell
should be
yes.
fine. But everybody wants to know about the raising assets part, which is obviously key. That's the simple but not easy part. As we've heard today from our panelists, there's no substitute for the hard work. And I'll just throw this out there again to our friends in the capital markets world. You can't neglect them. You got to be talking with them from day one. They are just as important as in this ecosphere as service providers, the exchange, everyone else. So we covered that on the asset raising side. Really quickly, just wanted to touch on the fact that you've heard a lot about reorganizations or conversions from mutual funds to ETFs. Those are obviously a great way to take captive assets and bring those over. Jay and his firm have been involved in things such as hedge fund to ETF asset migration, as well as what's known as 351 exchanges, or SMA, bless you, SMA to ETF conversions. So there's a whole host of other topics that involve let's say the dual buckets of captive and captive AUM that everyone can talk about. But again, before we leave here, just wanted to go back out there. We've got about 3 or 4 minutes. If there are any other questions that the panel can answer, we would love to have those thrown at us. Okay. I think
No one wants to know about the market research for the bad fund?
Yeah. Yeah. Yes, we have a ticket. Yes.
Well, you go to Vegas, you check out all the casinos, you drink all the booze, and then you see which J&J product works best the next morning to make you feel better.
Okay, I guess with that said, we can wrap it up. Right?